this is a new Dodd-Frank. It's an NPR. It's a notice of proposed rulemaking, and this is for the foreign banks. And I started my career in foreign banks. A couple of names that it's kind of hard to pronounce. Like one of my favorite banks that I worked for was a bank called Banco del Svizzera Italiana, which was a subsidiary of, I think it was J.P. Morgan at the time. This is going way back. And so anyway, being an FBO, the FBOs don't seem, it was always my, my concern that FBOs never had the reporting burden that all the domestic banks had. So it appears to be that Dodd-Frank is doing something about it.
No.
Okay, thank you. All right, so the overview of this is that there has been certain financial companies that pose a threat to the overall financial stability of the economy, and that's what Kenny was saying, where large FBOs operating in the United States could pose a similar financial stability risk. Number two is that the U.S. banking law and regulation allow well-managed, well-capitalized FBOs to conduct a wide range of bank and non-bank activities in the U.S. Another thing is that the FBOs have a USBHC, which is a sub of the FBO, the Foreign Banking Organization, that qualifies as a financial holding company and has not been required to comply with all the board's capital standards. And this is what I had said originally, that it seems the FBOs get away with a lot. They don't have the reporting burden that the domestic banks have. So, what has happened in the U.S., there was an increase in concentration on complexity and interconnectedness of the U.S. and the operations of the FBOs. Again, where lessons learned during the crisis have raised questions about the suitability of the approach of whether or not they're financially stable. Then Dodd-Frank walks in and requires the board to impose, what I'm going to go through, some prudential standards on large FBOs. All right, a little bit about the trend of foreign banks. In 2008, U.S. branches and agencies provided more than $700 billion to non-U.S. affiliates. As U.S. operations of FBOs received less funding from their parent, because FBOs in the very beginning were getting all their funding from the head office, and what has happened is that they started getting less funding from the parents, and then they became more reliant on less stable funding, where they were using short-term U.S. dollars for wholesale funding, contributing to, in some cases, to a buildup of mismatches. Remember mismatches of maturity by funding? That was a big thing that I've done in a lot of foreign banking organizations, where we had to go through the maturity ladder, and you had this big gap. When you had this big gap, you go crazy in the market and borrow money to cover that gap. So also the trends in the global balance sheets of FBOs reveal that the short-term U.S. dollar funding raised in the U.S. was used to provide long-term U.S. dollar denominated money to finance trade around the world, and this is a question mark for financial disability. Now, very interesting about the concentration of FBOs in the United States, that there are 10 FBOs now that account for roughly 2/3 of all the FBO assets in the United States. And another interesting statistic is that 5 of the top 10 U.S. broker-dealers are currently owned by FBOs. Believe me, and it's not National Bank of Pakistan, it's not National Bank of Kuwait. It's your Credit Suisses, your Deutsche Banks. I don't want to say it. Okay. Now here comes the requirements for the FBOs. If the FBO has an asset of $50 billion and has combined U.S. assets, excluding its branches and agencies in the U.S. of $10 billion or more as of July 1st, they must, it begins on July 1st, 2014, and by July 1st, 2015, it must establish a U.S. intermediate holding company called an IHC, which is the equivalent of a BHC. And they will have the same requirements as I'll go forward. Currently, their requirements are going to run concurrently with the FOI 7. Everybody knows the FBOs know what the FOI 7s are. The FOI 7 is the FBO's version of the FOI 11 and 2314. So, as part of the reporting requirements, there's going to be a Tier 1 risk-based capital ratio, total risk capital ratio, Tier 1 capital, Tier 2 capital, RWAs, risk-weighted assets, total assets, consistent with the transition period of Basel III requirements, and a certification of FBOs in the United States that meet a prior notification of 12 CFR 225. I don't know why I put that in there. It's almost like a Kenny mistake. But anyway, okay. Now here's the best part. What's their additional reporting? Their additional reporting, and this first page is what I've been doing for the last 4 years of all these reports. Risk capital reporting for institutions subject to advanced capital adequacy framework, and that's the 101, and that's a very, very detailed report. Then also, which the FBOs have not been privy to, is the consolidated financial statement of all the entities of the FOI 9C, which is somewhat comparable to the domestic core report, where the foreign banks, they had it real easy doing their core report. They had no capital requirements, they didn't have to break out interest, they had it real easy. Then also, in addition to that, you got the financial statements of foreign subsidiaries of the U.S., 2314, the short form, the comparable non-bank securities, FOI 11, and the short form, and the famous report that Kenny was talking about, the 009, the country exposure report. Really, it's not as bad as you really think it is. Axiom solution, really get down to the nitty-gritty of that.
Check mark for your bonus. Very good.
Okay, and then you have all the other reports, which are smaller reports, smaller versions, except for the 9LP, as he mentioned, that has to reconcile to the FOI 9C. You got the annual report of holding companies, the bank holding report of insured depository institutions, I always love this one, the financial statements of employee stock ownership. I love to see those things. A lot of it is confidential. Report of changes in the organization, the FOI 10, that's a list of all the entities. Then there's a merchant banking investment report, and then there's a new report that's been, just came in, I think, the last 3 months. I forgot when it's due. It's called the FOI 15, which is, I can't remember. Oh, that's a systemic risk report. Okay, and then I hope you FBOs paid attention to Rob's presentation, because now here comes the CCAR, and it's not one of those Yugoslavian cars. It's capital assets and stress testing, comprehensive capital analysis, and yeah, okay. You know, with all these acronyms, I don't know how anybody could remember exactly every single acronym. Comprehensive Capital Analysis Review. Okay, so it's going to be capital assets and stress testing for the monthly, quarterly, and annual. Liquidity requirements per the FRB rules. Single counterparty credit exposure limits. Establish maintenance. They have to establish and maintain. So what you're doing, you're struggling to reconcile and validate. So that's one of the problems. And what happens with the CCAR, you have to reconcile to the to the 9C with all your granular data to the general ledger. Striving to audit and cross-check everything to make sure that everything that you're getting from all the subsystems is the correct values, and how do you make sure that it is that there is integrity behind it. And then aggregating and consolidating, difficult to calculate and follow rules. You struggle in a timely manner to try to be compliant. Again, just like every vendor out there in the market, what they always say is too much time is spent on preparation and less time spent on analysis, which is true. And I guess that's why all the vendors say the same story. All right, so again, the value added, if you paid attention to Rob's FOI 14, it's basically the same thing. What it is Axiom provides flexibility. It's adapt to both internal and external changes. Internal changes, new systems coming in, merges, etc., and all the external changes by the Fed. And like Kenny said, that's how they make a living. They just keep on making new reports. It's a controlled environment. It's all in the same place at the same time. There's integration. You're sourcing from many different systems to a single platform. You're leveraging data with data models, business rules, workflows. Everything is all well organized. And again, as we keep mentioning, it's the transparency that it's your data, rules are being written on your data. That's one of the key points about Axiom's value. And then the robustness of Axiom manages data volume, which some vendors out there can, and my ex-company couldn't. And then scalability of vertical and horizontal. Now this is my favorite part. Conclusions. What's going to happen? What are their options? All right. One option is it would be able to maintain the U.S. operations for the FBOs. Their first option would be to raise capital, specifically for their U.S. units, most likely through the sale of new shares to investors, similar to the capital raising by the Swiss in the past. And what's been done now, it's in at the beginning of May, or June it was, just last week, that Bank Paribas had merged with one of its U.S. subsidiaries, Bank of the West, and the reason why they merged was they're preparing to establish the IHC, and they bought Bank West for two reasons: one for its capital, and two for its deposits. So we could see already happening, thanks to Bank Paribas, the French. The second and more practical approach would be to reduce its U.S. assets. That means there's going to be a lot of sales out there selling all their assets. That's be billions and billions of dollars of assets being sold in the market. Almost like a flea market of buying assets. Another option, and I hope this doesn't happen, is to exit the U.S. market. Now, how could we have life without FBOs, without the Credit Suisses, without the Deutsche Banks, without the Banca delle Svizzere Italianas? And that's about it. Now, one more thing I want to mention, that, okay, now the Fed is coming down on the FBOs through the IHCs, and also that there are changing requirements for non-bank SIFIs, which are systemically important financial institutions, and they're going to be subject to heightened oversight by the Fed. And they were mentioned as Prudential, they're mentioned as GE Capital, and I forget who the third one is, and it's probably a client of ours. So with that, that's the trend of what's going on with foreign banking organizations. I prepared this report. Another SME had helped me understand and translate this, which is Eric Spar, who's been around quite a long time, just like myself. So do we have any questions out there that maybe we can answer? If we can't answer,
Oh, if we do just a quick one, because we're running a little
Sure.
behind on schedule, but as you might believe, I mean, I'm sure I won't surprise anybody, Tony will be at the cocktail as well as Eric, so.
what a reputation.
Thank you very